Apple, the holy grail of humongous cap stocks. Today, I'm going to show you the fundamentals of Apple. I'm going to take you into the software, this amazing software by the Everything Money guys, and show you some metrics, use the stock analyzer tool to put in my assumptions about the future based on their historical performance, make assumptions about things like revenue growth, what price to earnings ratios we can see them trading at. At the end of the video, I'm going to tell you what I am doing in regards to Apple. First of all, we see that it is an insanely huge company, almost a $3 trillion market cap, and the revenue has been the past year $378 billion, with net income of $100 billion, a price to earnings ratio, which is their market cap divided by their earnings, of 28.9. Their 5-year PE, the average has been 43, so they are trading at the lower side of that. They pay out 0.5% in dividends, and that equates to 14.5 billion paid out to their shareholders, and that is from a cash flow of the past year 100 billion. So they can easily afford. Over the past 5 years, it has been an average 31.7%. That is the return that Apple will generate when you give them your money. If you give them $100, they will basically generate a return of like $30, $31 for you. That has been the average 5 years, but the past year they have actually been doing even better with a 44.7% return on invested capital. So they're great at using the money invested to generate returns, which is a fantastic thing. So we want to see here on the balance, we want to see here in the income statement, are they actually growing? So for that, we go back 5 years and we see they did $229 billion. The past year, they've done $365 billion. These numbers are so high, I can't even comprehend, right? So great growth, especially for this insane market cap. It's crazy that they can still grow at the rate that they have been doing. And yeah, we want to see their shares outstanding either decreasing or staying the same. And that is because we don't want a company to dilute us as shareholders, actually inflate the stock price. And they do that by issuing more shares to us that we don't want, because then our share drops in value. And that is why we want to see them buying back their shares or just not doing anything. And you can see here, 5 years ago, they had 20.8 billion shares, and now they have 16 billion, 16.7 billion. They are massively buying back their shares, so that is probably why they don't pay out that big of a dividends, because there are a couple things, there are actually 5 things that a company can do with its free cash flow. One, they can pay down their debt, they can make acquisitions, they can reinvest into the business, and here the 2 last ones, they can either pay out dividends or they can buy back their shares. And they pay out a tiny dividends, right? So what are they using the free cash flow for? Probably buying back a whole bunch of shares, which we can see that they have been doing. So that is a great thing. That means that your stake in the company increases, and you don't have to do anything. You don't even have to pay taxes on that increase in stake. Yeah, whatever. You can see here that we want to see their financial position being just absolutely beautiful, and you can see here they have $62 billion in cash on their hands, and they have, oh my god, 216 billion in long-term assets, and that beautifully covers their long-term liabilities of 162 billion. So yeah, that covers almost 2x. No, not 2x. That covers like not 2x. Okay, that covers their liabilities beautifully. So good financial position, and we want to see their cash flow increasing, which, spoiler alert, from 51 billion 5 years ago to 92 billion. Check mark there. For the 8 pillars, we want to see this nice and green. We can see here that their return on invested capital is much greater than their 5-year return on invested capital, sorry. That is 31, incredibly high. They are also good at growing their revenue over the past 5 years, check mark there. They have grown their net income over the past 5 years, check mark there. Their shares outstanding, another thing that a lot of investors really love. and also why I think Warren Buffett still holds this company after so long, and he's just made so much money off of this company, but he still keeps holding it because he just gets a larger chunk of the business. Every year he waits, he'll get more. So that is something that I think he really likes about Apple. They are in a good financial position. We can see that here with their long-term liabilities divided by the 5-year free cash flow. We want to see that less than 5, and we can see that is 2.2. And their cash flow has been growing massively. And the 2x's that we have here. You might be wondering, why can this insane company have an X? Well, these are the 2 value indicators, and that is their price to earnings ratio and their price to free cash flow. I want to say this is their average 5-year, and they're much lower now. They're actually almost nearing this, that we want to see the 22.5 for the price to earnings and the 20 that we want to see for the price to free cash flow. Right now they're trading at a much lower premium than they have been over the past 5 years. So yeah, but still, since they're red, does that mean that we are automatically going to skip the stock? Well, no. That is why we use this amazing stock analyzer tool here. Because this tool allows us to go ahead and use 10 years of analysis, put in our low, mid, and high assumptions about the future. We of course want to base that in some historical performance, and then we can make our assumptions, and then we get a price target that we want to be paying for the company. So for Apple, we have to remember that the past year they have been doing very, very well. And this is priced in, this is like into the average of the 10-year. So the past 10 years, they've grown their revenue an average almost 10% year over year. But this 28% has been baked into that, right? I want to be conservative when I make my assumptions, because that will provide a nice margin of safety for me. I don't want to find these deals that are kind of good, kind of bad. I want to find these deals where it's just amazing value that you get for your money. So you have to think about, well, their revenue is what, 100 and 200 billion, I don't even remember, 200 billion or something. Like, if we think that is going to double over the next 10 years, well, they're making close to $500 billion in revenue every year, and I don't know how realistic that is. So I want to be conservative here with my estimates, with my assumptions, but still we have inflation. They at least have to cover that. So what I'm going to do is go 6, 7, and 8. And you might think that is too conservative, but let's see what this gives us. For their price to earnings, guys, when the company grows even more, I think it's a pretty high price to earnings, to be honest, that they're trading at. It's the biggest company by market cap, right? For your money to double with this company, you have to see the market cap going to somewhere around 6 trillion. That is an incredible amount of money, right? So we have to be realistic with the premium that we will be paying, because how much can this company actually grow in the future? So because this is simply such an incredibly huge company, I'm going to put in these assumptions here. And these will likely give you some red numbers, to be honest, because they are much lower than they're currently at. So be prepared. But for the desired annual return, I'm going to put in 12.5%. And the reason for that is that I'm not here to give you an exact price estimate of what the company is actually worth. I can do that afterwards. In the S&P 500 over the past century, that index has generated an average annual return of 10.5%. So we actually want to make it worth our while and provide that margin of safety. So there are multiple reasons why we put those in there. So here we have a high estimate of 100, a mid of like $80, and a low of 70. Should I put in higher revenue growth estimates? I don't know. But let's just say we want to find out what this company is actually worth, like the share price. We're looking at, yeah, 100 and like 20, $100. That is what I think it's worth. But still, over the next 10 years, well, we're probably going to see somewhat hyperinflation or very high inflation. So is it really fair? Smartphone prices are probably going to go up a lot and things like that. So maybe we should actually go a bit higher. You know, usually over the past like century, inflation has been like 3.5% or something. So we're probably right now we got like 8% inflation or something. If that is going to continue, then we probably have to put in some higher numbers here. So I think these numbers are probably viable here, and it's still overvalued. So if you believe in these assumptions that I made here, then you should be paying, well, either of these prices for Apple. So go out there and make your own assumptions and use your own assumptions to come up with some price targets, because this is just what I believe in. If everything is red here, you might be wondering, well, why is Warren Buffett, the great oracle of Oklahoma, holding this company? I think it's because of a couple of reasons here. He has generated such a huge return on his Apple investment. And really, he has no reason to sell. Why would he sell if he haven't got a better place to put the money? It's like Charlie Munger holding Costco. He's generated a huge return, but it's now looking a bit overvalued. So you might ask, why doesn't he sell? Well, they're decreasing their amount of outstanding shares so much, and they are generating such a huge return on their invested capital. I think there are a couple factors that make this a great hold for investors like Warren Buffett, that already have been like really blessed in this company, from this company. But if I was given $1,000 right now, I wouldn't throw them directly into Apple. So what am I going to do in regards to this company? Well, I'm going to put them on a watch list for, I can actually do it right now here. So I believe in these estimates. I believe in $100 approximately. So what I'm going to do is hit this button, add it to my watch list, notify me when it gets below this price. And well, now I know that, I'll get an email notification whenever it hits this price. But the thing is, I love everything about Apple except the valuation. That is my take on Apple, guys. I hope you enjoyed this video. If you did, make sure that you follow my channel. I take a look at all sorts of companies that I find interesting, that I'm buying. Go and watch this video next, because it will show you me analyzing a company that I really find great value in. And go and follow my Instagram right here, MRGODVIL. Post things on investing, finance, business, all these things. With that said, have a great rest. With that said, have a great rest of your day. Bye bye.